Brett Hammond is the Managing Director and Chief Information Strategist for TIAA-CREF. TIAA-CREF, for those of you that aren't familiar, is a fund manager with a little over $470 billion under management. Dr. Hammond received his Bachelor of Arts degrees in Economics and Political Science from the University of California at Santa Cruz, and he earned his PhD from MIT. He's published numerous articles and books in the areas of finance, higher education, and public policy. In addition to his work at TIAA-CREF, he is an adjunct professor at the Wharton School of Business and the executive chair of the Research Council on Global Investments. That's an organization of senior leaders in pension and investment management. So let's give Dr. Hammond a warm St. Vincent College welcome.
Turning this thing on. Am I on? Good. Thank you. Well, thank you so much to St. Vincent and St. Vincent's friends. I'd like to think of myself as a little bit of an old St. Vincent friend, because we were talking earlier, and when I knew I was coming here, I was really excited because I was here once before. Our family nanny for my kids got married in the Basilica, and she attended St. Vincent College, so I was here about 10 years ago for that, and it's a big treat coming back. It's also a big treat coming on a day like today, but of course we tried to pretend and make you think that the weather isn't good. Well, thanks for coming anyway. So today we're going to talk about, or tonight we're going to talk about a fraught topic. So I want to get right off the bat. I want to talk, acknowledge the fraughtness of this topic. This is going to be about politics, and it's going to be about the economy, and it's going to be about markets and voting and presidents. And in our, sort of current political environment, it can get tense, or at least we've seen these things get tense. When we're watching TV and seeing debates and watching gridlock in Washington. Well, we're hoping that's not going to happen here, because the point here is to be analytical, not partisan. So if you catch me thinking, saying something that sounds to you like I'm pushing one side or another, absolutely call me on it, because that's not the intent here. The intent is to have a little fun, to learn a little bit, and to shed some light on some stuff that may be going on with respect to those topics. Electing the market we want, because it's a really interesting set of topics. The beginnings of this sort of field of study in academia, as well as in practice, because it's become a topic of study for presidential elections and their staff. There's a lot of money that gets ground up thinking about how to position any kind of official who's running for office, or aspiring official running for office. There's always a lot of thought about this now in analytics. I actually was lucky enough to be around for some of the early days of this when I was a graduate student. So the early days of what? Well, you heard I went to school at MIT, and I did a economics and kind of public policy degree. And what it meant was that I was taking classes both in political science and in economics. MIT has an interregnum period in January, like many schools. They won't start classes up again until February 1st after the first semester. And the notion in those days was to put on, for students, graduate students, to put on, organized events. And we decided to organize one on what do we know about presidents and the economy, or the economy and presidential voting. This is back in the 70s. That's how old I am. And we got what we thought were some great political scientists, an economist I'm going to talk about later, a guy named Ray Fair, and we got another economist named Paul Samuelson, who was one of the most famous economists in the world, to come sit and be the guy who comments at the end of the whole thing. So we did a day and a half, people presented papers, and it was pretty primitive. Both the methods were fairly primitive, and the number crunching wasn't as sophisticated then as it is now. And the theories hadn't gotten particularly sophisticated, but there was some sense in which in a kind of primitive way, that they could find evidence from the focusing on presidential elections going back to Hoover, that there was some influence of the economy on presidential outcomes, so that they were able to tease out that, yes, when the economy is doing well, an incumbent tends to get a boost. Okay, so very simple, pretty primitive. And we get to the end of this thing, and the graduate students are all excited because we gathered all these people. We got Paul Samuelson, how many millions of textbooks did the guy publish? Weekly column in Newsweek magazine at the time, one of the first winners of the Nobel Prize in economics. So we then say, comment on this, Paul. And Paul says, well, it's a good thing that the young scholars here today, only do this kind of work on Friday nights and Saturday afternoons, because it's not real economics. And that was the end of his comment. So everybody sort of hung their head and went away. Well, since then, there's been a lot of work on this. And as I say, it's driven both by an understanding in economics and in political science that this is an interesting topic, because more evidence has become uncovered. There's new theories have been developed, sort of better methods. And so there's really something here, and it's also part of the sea change that's been going on in economics, where it isn't just about a disembodied macro equilibrium theory, but there's a sense in which other things like human behavior actually play a role in economics. I'm exaggerating, but you get the point. And then in addition, as I mentioned a minute ago, the sense that the candidates and their campaign staff think that there's some important connection between economics and voting, so they want to study it so they can influence an election. So that's been the impetus for this, and it's gotten much more sophisticated. So the topics that we might want to spend a little bit of time on, and I don't have a lot of slides, but we'll talk about these, and I'll bring in some of the evidence. But the topics we might want to cover are the influence of markets and the economy on presidential elections. So you can think of an arrow going one way from the economy to elections. So when the economy and the markets are good, what happens to elections? Then you can look at the arrow going back the other way, which is what happens to, what do politics or presidential elections, how do they influence markets? Because you can ask the same question. Which influences the other, or can the arrow go in effect in both directions? So a crude way of putting it is, can political parties and presidents and so forth influence markets that will then put them in a good light and put them in a better position to be elected? Okay. The third one is we just want to talk about maybe a little bit about the 2012-2013 economic and market forecast, which might be a way of saying, who's going to get elected? Or more important, the fourth topic is, what are the implications for investing regardless of who's going to get elected, or including who's going to get elected? Now, does anybody know, well, let's talk about some hypotheses, then I'll ask a question. So these are all pairs, these hypotheses, each pair. One hypothesis in all of this is that presidents elect themselves. That presidents do things, and their staff do things that have a big influence on whether they get elected or not. And you could say this about challengers, too. I mean, presidential aspirants, whether they're incumbents or challengers, what they do really matters in terms of whether they get elected. Well, kind of we think that's true, right? Why would we have had 20 Republican debates if we didn't think that, that candidates actually could have some influence over whether they got elected? Or another way of thinking about it is, it's the economy stupid. Anybody remember the Clinton campaign and it's the economy stupid? So in other words, presidents don't have as much influence, and if the economy's doing well, then the incumbent may get a boost. If the economy isn't doing well, then the challenger may get a boost. But there isn't a lot of influence that these folks have. So there's another, doing some straw men, and the truth may or may not be in the extremes, but it's a way of thinking about it. Second one is incumbents collude to influence markets. Or, I'm being very careful about incumbents. Incumbents can be the president and Congress, let's say, whether the president and the Congress are in the same party or not. It's just that incumbents want to collude to to influence the markets to be very good so that people, and the economy to be very good, so that the incumbents will have an advantage. Or parties tend to neutralize each other. You know, they tend to bash each other or work at cross purposes, and therefore they don't end up influencing the economy and maybe influencing voting. Third, Republicans are good for the markets. Or Democrats are good for the markets. Which is it? We'll see a little bit about that. And then I got to bring in the Fed here too. So this is a little orthogonal, but I got to bring in the Fed. And the Fed, of course, has a responsibility for inflation, and controlling unemployment. That's a statutory responsibility. And the Fed does that by various mechanisms like interest rates, you know, the things that we've heard so much about the last few years, you know, controlling interest rates, buying up securities, open market operations, jawboning, i.e., you know, talking a lot to the American people to try and keep the economy under control. And the question is the Fed biased, or does it kind of become neutral when elections are on the horizon? And that's an action. You know, how much does the Fed influence elections, in other words? And then finally, markets show a distinct political election cycle. So that would be the hypothesis that you can actually influence the market if you're a political official, especially a president and Congress, or correlation does not equal causation, which is another way of saying whatever we observe in the markets may or may not have anything to do with whether a politician caused it. All right. So we'll come back to all these, but I wanted to kind of go through them because those are some of the major hypotheses that exist in this field. And of course, you can imagine that the academics in this field are a little bit more neutral and tend to say, well, you know, we have to look at the evidence, it's not clear sometimes, whereas the practitioners, you know, the folks who are working for candidates are saying, oh yeah, we can have a big influence on a lot of things, and you can pay us and we'll help you do it. Okay. So let's look at the first big topic, which is, do the markets and the economy influence voting and elections, and with a particular focus on presidents? And this is Ray Fair. I mentioned Ray Fair because I was a graduate student. He wasn't much older than I was when we had this seminar in the 1970s. He was a very young economist, and he built a very simple model, very small model. He actually has one of the whole U.S. economy. And in those days, he built a whole U.S. economic model out of 20 equations just to see if it would forecast correctly. And the prevailing models were like 500 equations at the time. And so he built, as an addendum, he built this little model to talk about presidential voting. And what you see here is a table that has dates on it, and the dates are when he ran his model recently. So starting in the end of 2010. And the most recent one that I've come across is the end of January 2012. So it's a little out of date now. And what he's doing is looking at these variables. So he's looking at G, which is the growth rate of real per capita GDP in the previous 3 quarters. So how fast is the economy growing? Okay, that's G. P is the growth rate of the GDP inflator during the presidential term that's currently underway. Well, what's that? That's kind of a measure of inflation. Think of GDP deflator or inflator. I think I should have written deflator, but it's a kind of a measure of inflation. So think about P as that. Z is the number of quarters where GDP exceeds 3.2%. And a way to think about that is recently, not very many. So you see in 2010. The number of quarters in the most recent, over the last few years, like 4 years, where GDP exceeded 3.2%. Well, we know that the economy has not been growing very fast, right? Last year it grew at around 2% on an annualized basis. And what it's really saying is that in the end of January, 1 quarter in 2011 was above 3.2% on an annualized basis. Whereas in 2010, if you look back 6 quarters, the economy was growing pretty well, not in 2010, but before 2008. And so it's picking up some of those quarters in the previous 4 years. So that's what Z is. So the G is the growth rate of the economy. Z is just simply the number of quarters where the growth rate was good. It turns out that these are significant variables in the model. Then VP is the predicted vote for the incumbent, and VC is the predicted vote for the challenger. And of course, he's not saying Republican or Democrat. He's looking at, because he runs this model year after year. He's done it for 30 years. So he's always looking at the incumbent versus the challenger, no matter which party they are. Okay, so what does this then say? Well, it says that in the end of 2010, and even through the middle of 2011, the incumbent, which is VP, was doing pretty well. Not spectacularly well, because you can see this is the predicted percentage vote. It starts out at about 56% versus any kind of challenger would be at about 50%. Not spectacular difference, but the race has tightened since then. And now what he's saying also at the end of January is that it's not tightened so much that he can't, at least at the moment, predict that the incumbent, based on these economic variables, is more likely to win than any challenger. I mean, we know who the incumbent is. It's Obama right now. But again, he's run this for every administration multiple times, as you can see. So what's really going on? Here? Well, what's really going on here is you can see that the percentage vote for both the incumbent and the challenger have dropped some, more for the incumbent, and the reason is that the economy went south a bit last year. It's been growing since the Great Recession, right? During the Great Recession, we lost something like 8% of GDP, which is the worst performance since the Great Depression. Okay, so we know that. And nobody blamed Obama, at least at the time. But then what it's saying is if when Ray Fair looks back at economic growth and other kinds of related measures, he's saying that voters pay attention going back 2-3 years. That's really what this model is saying. That voters look back about 2-3 years, but they actually, there's a heavier weight on the most recent times. It's how you feel now or what's happened to you recently. And so what happens is last year, the economy was expected to grow pretty well last year compared to what it had been. A lot of people were expecting a 3 to 4% economic growth rate in the United States. And it turned out to be 2%. And the 2% happened, the bad part happened in August, September, October, where the economy just goes bleh. That's a technical term. And you remember there was a lot of market volatility during that period. There were some disappointing economic results. And good news was that the economy didn't get worse and do a double dip. It came out at 2%. So the result was people were feeling more nervous, and they started their support for Obama, or at least the incumbent, dropped a little. But the economy has come back a bit. Economic growth is a little better than it was now, and people were starting to feel that in January. So it kind of leveled off, and there's still a gap between the potential vote for the incumbent and the potential vote for the challenger. We don't even know who the challenger is. He's just running this model without knowing. It doesn't even need to know. So, but what he's also said about this is that if economic news, it's pretty shaky, because if economic news starts to be a little less positive, and it's not particularly positive right now, but it's somewhat positive right now. We've been hearing better things about U.S. economic growth, about corporate earnings, about the creation of new jobs. Those things are all a little better than they were. And voters have felt that. But if those things don't keep going on the current trend, this could tighten up even more, and the challenger could easily pull ahead. So he's saying this is not a slam dunk for Obama, but right now it's leaning toward Obama when it comes to potential votes. And he'll run the model again, and keep your eye open or search on the internet, and you may see a new release from him in a month or so, because he keeps doing this every couple of months. Okay, so that's one way of thinking about this. And what it says is that the economy really does influence support for the president. Okay, so that's not an extreme statement, but it's pretty well documented by now. Ray Fair isn't the only one who's done it, but this is a nice way of seeing it because his model is fairly simple and it works pretty well. He's done pretty well at predicting the outcome in elections. And when he hasn't done well, he's been very good about analyzing why. But generally, he's done a pretty good job of predicting. And he even will admit, you know, when it's so even, he can't predict. He'll say, look, the model doesn't, you know, won't tell us. Right now, Obama's a little bit ahead, but it could change. Okay. So the other question is, well, let's back up. The other question is, okay, maybe the economy influences elections. But does it is it determinative? And we'll come back to this. Can presidents or incumbents make a big difference? Can they manipulate in a good way? I don't think necessarily in a bad way, but can they influence the economy so that in turn that can help them? We'll see that. Notice Ray Fair isn't arguing whether or not they can do that. They're just saying the economy does influence elections, and he's not arguing one way or another about whether in turn presidents or parties can influence the economy, which then can help them. We'll see. We'll go back to that. What I want to do here is use this one as a way of talking about some fundamental changes in the American electorate that, and this is something you won't, it's a little less common to think about this than just simply do elections, does the economy influence elections? This is actually at a deeper level, because you can go to a deeper level and say, has the economy influenced the American electorate and its fundamental characteristics? So, and that's different from a single election. And so let me talk about this particular strand of research. This comes from research that asked, what's happened to the American electorate? Now, we know from in an anecdotal way or from in a general way, we've heard about party polarization, right? That the two parties are much more polarized than they used to be. The Democrats are much more left-leaning, the Republicans are much more right-leaning. Yeah. And there's a growing, I'm trying to get my left and my right straight, and there's a growing number of independents, right? So the influence of parties altogether. And there's a lot of reasons for it that people say, but the real question is, so what? You know, what is it true and so what? So this research decided to ask, what kind of polarization has there been? How could we describe it? Or could we evaluate it and analyze it using some serious research techniques? And then, what does it say? So for example, one question is, incomes have risen in the United States in the last 30 years, 30, 40 years, right? I mean, they haven't risen in the last 10, but certainly before that they did. And what that might predict is that there'd be more Republicans today. Because traditionally, higher income people tend to include more Republicans than lower income people. Very simple, right? There's a lot of nuances that I'm not taking into account on that one, but it tends to be true. And so you'd think that if incomes go up, there'd be more Republicans. Turns out that there's a lot more independents, but the parties are still pretty well balanced. You know, Republicans will win one election, the Democrats will win another one, the Congress and the president will be divided. There's an awful lot of parity in this, in the American political system still, and yet incomes have gone up so much. Well, step one here, it's not on the slide, but step one in this research looked at this and said, what's going on? And what they found when they did some more sophisticated analysis is that, yeah, incomes have gone up, but what happens is that people think of themselves as, in relative terms, economically, their own individual situation, in relative terms. So incomes have gone up all over the United States, but people sort of compare themselves with other people, and therefore you didn't get as big a shift towards Republicans as you might have thought from the rise in incomes. So everybody got richer, and that didn't change so much the entire makeup of the American electorate. Right, because they're thinking, am I relatively better off than that other guy? Well, no, so I'm still a Democrat. Or I am relatively better off than that other guy, so maybe now I'm a Republican. I mean, it's not purely causal, but there's a tendency in that direction. Okay, so that's kind of conclusion number one. But then the question is, okay, but there have been these huge changes. Where does the polarization come from? It isn't just that we now have, we used to have parties where the Republicans, there's a lot of overlap, right? The Republicans included a lot of liberals and a lot of conservatives, and the Democrats included a lot of liberals and a lot of conservatives. And that has gone away, or at least a lot of it has gone away. And where is it gone? How has it gone away? Well, in very simple terms, what they found was, I have two factors down at the bottom there. One is Southern realignment, so let's talk about that one first. Southern realignment is the sense that the South was solidly Democrat, decades ago, right? Now it is much more competitive, but more leaning toward Republican. So the South has had a big realignment in terms of the dominant party ID, and what that's done is help to polarize the parties, because the electorate in the South turns out to be more Republican is of course very white, and the South used to be both rich whites and poor blacks voting Democrat, and now it's relatively well-off whites voting Republican and relatively less well-off blacks voting Democrat, or most all blacks voting Democrat. Same with Hispanics. So you get this polarization, especially in the South. You get much less of it in the North, or the non-South is the way the research goes. But there's actually been a small trend, not as big as in the South, but a small trend toward Democrat affiliation in the non-South. So there's a big push toward Republican, a small push toward Democrat in the rest of the country, and you get parties that are still fairly equal, but much more polarized. So much more homogeneous so far fewer liberals in the Republican Party, far fewer conservatives in the Democratic Party. And then there's the issue of the elite polarization, and which is kind of interesting. So what this slide actually shows is party stratification by income. So what the black line is showing, where it says stratification, is you see kind of an upward trend there, which is what they're measuring is the whole country going more Republican. And in fact, it's showing a modest change towards more Republicans. It's up and down, but you can see a modest change toward Republican. But what they're measuring, in effect, here is stratification, which is the sort of the richest folks minus the poorest folks, and then what is their party ID? And so you see the black line kind of trending upward, which suggests that there's that the rich folks, there tended to be more heterogeneity in their political beliefs. So there was some rich folks who were Republican, some rich folks who were Democrat. Well, there's a small trend toward the richer folks becoming more Republican. That's the idea here. And then you see the dotted line, which is actually Republican presidential voting, which kind of goes along with it. So it kind of confirms that trend. And in other words, the voters themselves, when you not just Republican Party identification when you poll them, but the folks who are actually voting are going in the same direction. A little bit of an upward trend in income. So remember, I started this by saying that you'd expect that a big change in income would have just really produced a lot of Republicans. Well, a big change in income produced a small increase in Republicans, but not that huge change. And the biggest change has been in the Southern realignment that has produced a lot more polarization. But both the elites and the South have increased polarization in the parties, and a lot of it is there are these big demographic and economic changes that are helping to drive this stuff, but in a fairly subtle way. It isn't just completely straightforward, because you get regional shifts, you get overall economic shifts, but that is helping to explain why these parties are starting to behave the way they do, or have been behaving the way they do, in terms of polarization. Okay, so let's now move on to another one of the topics, and that is we're going to start looking at, can presidents influence, or can parties influence elections? So what does this picture show? Well, it shows stock performance after presidential elections. So the 0 on the horizontal axis, if you look at that, the 0 is the day of the presidential election, okay? And then you see a minus, because they're looking at days before the election. So they're going about 200 days before the election. And then they go 200 days after, 400, 600, and 800 days after the election. And what they're looking at is the performance of the stock market. Now, the stock market tends to go up, right? It doesn't always go up, but there's a tendency for the stock market to go up. So you're going to see that in all presidents, that's the middle line, the stock market does go up during most presidential, if you average presidential terms and put them all together, the stock market is trending up. But sorry that we didn't make this clearer, but let me assert that these two lines, the two dotted lines, are different. The top dotted line is Democrat. The bottom line is Republican. There is an unassailable trend. Now, notice I'm not explaining that trend at the moment. We'll get to that. But there's an unassailable trend that the stock market does better with Democrats than it does with Republicans, and it does better by a lot. A lot. I'm not explaining it yet. Remember, we're not trying to argue that somebody's better than somebody else. But it turns out that starting from the day of the election, Democrat administrations enjoy a much better stock market return, and it's been going on for a long time. They measure this starting in 1925. That's when the data started getting good, and it's been going on. Now, does it happen all the time? Well, this is 1928 to 1996, but does it happen all the time? Well, wait a minute. It didn't happen in the Obama administration, did it? So Obama takes office in January of 2009, or did it? When did the market bottom out? March 10th, right, or March 9th, I forget which day, but March 9th or 10th, 2009. So the market's going down a lot in the first couple months of the Obama administration. But what's it done since then? It's gone up 90% or more. We may be hitting close to 100. I may be out of date. So things have done pretty well during the Obama administration. Okay. Was that true in Clinton? Yeah, it was true in the Clinton administration. So it is generally the case that this happens. So what's the explanation? Is the administration, are Democrats somehow better managers of the stock market than Republicans? I mean, you could argue that's the case, because here's a correlation, right? Democrat, good. Republican, bad, right? It's a correlation. I didn't say it was causation. But then you need an explanation for why this is the case. How could it be? And there are definitely competing explanations. One is that Democrats are better for the economy. So it turns out that bonds tend to do better under Republicans. The bond market tends to do better under Republicans. And the stock market tends to do better under Democrats. Now, maybe it's that Republicans care a lot more about the bond market, and they want to have policies that help bonds and that sort of thing, and Democrats are better for companies that issue stock. I don't know, but nobody's proved that. That's the point. An alternative explanation that people have offered is that Republicans clean out the economy so that so the stock market is poised to do well when Democrats take office. Nobody's proved either one. I mean, I see heads nodding about one or the other, but nobody's proved either one. It just turns out that that's an interesting conclusion. And I'm also going to give you a hint about kind of the bottom line in all of this. This is, there's going to be more bottom lines, but it's a lot of the phenomena that you find when you do the actual research, you find that there's no real evidence for why. And we'll see more about that later. Okay. But there's another phenomenon that goes along with this. It isn't just that the markets tend to do well in Democrats versus Republicans, but that the markets tend to do well in a certain part of a presidential term. Okay. So what I've put up here are presidential terms from 1942 to 2004, just because that's the data, and I can fill in the other stuff. And you can see there, the second column is the month and year of a market bottom. So when the market goes down, when does it hit bottom and when does it start back up again? So in 42, the president takes office, this should be 41, sorry, that's a typo. So the market hits bottom in April 42, and it's the second year of the presidential term. Okay, so again, it should say 41, and then you look in 2001, 2004, with the market was really going down. The market hits bottom in and again, there's a typo, but October of 2002, which is the second year of the presidential term. And then it comes up. If you remember, there was that big meltdown. Well, our recent meltdown made that look pale by comparison, but we thought it was a big meltdown from the dot-com boom. And it melts down, and then it hits bottom in October of 2002, and then the market actually does pretty well for a few years after that. Pretty good returns. And but look at those numbers on the right. Most of them say for the second year of a presidential term, the market hits bottom. About an average of about 1.87 years into the presidential term. And this is Republicans and Democrats. So it's not saying, are Democrats doing better than Republicans? It's saying, in all presidential terms, there tends to be really strong tendency for the market to go down or not do very well. Let's say not do very well, because it could be just going flat. Not do very well in the first couple of years, and then it takes off in the second couple of years. What's going on? What's going on? Well, hypothesis. Presidents do affect, or incumbents can affect the markets. And what they do, they come into office and they want to get some things done, so they do them. Ooh, think healthcare reform? And then they realize they're a couple of years into the term and they say, oh my God, I got to get reelected. And I think that the way to get reelected is to juice up the economy. So I'm going to spend money. I'm going to badger the Fed to lower interest rates, if I can get them to do it. They're supposed to be independent. But it isn't just the president. The president needs some help because they've got to get some of this stuff through Congress. Oh, I'm going to do pork barrel spending. I'm going to do a lot of things. But I need to get this through Congress. Who can I get to help me? Maybe it's the other incumbents. It doesn't matter what party they are. We all have a common interest in getting reelected. So if I'm a Republican president and a Democratic Congress, or vice versa, we all get together and say, let's reelect ourselves. So let's pass some spending money. Let's get some pork barrel. Let's do a bunch of things that will get us reelected. And that's a big theory. It's a theory that's very widely held among both, has been widely held among both researchers and the public. It's called the presidential election cycle. And it's taken on a real name like the presidential election cycle. So you juice up the economy. The stock market, by the way, we know this, stock markets tend to anticipate economic growth. So they don't follow economic growth. The market, the big boom in the market starts on March 10th, 2009. Well, that was the worst month of the worst quarter of the Great Recession. And it's because investors started realizing that the market might actually, or the things might get better, so they started bidding up stocks in anticipation. So the stock market anticipates growth. And so this is what happens. The stock market begins to notice this stuff somehow, and this political election cycle, so it starts going up. And then the economy starts improving. And so by the election time, the incumbents are happy and they get reelected. Well, it's a theory, right? Now, pause. I have to throw the Fed in again. Remember I said I would. Is the Fed role in elections, is it neutral or active? Well, there's two theories. One is that the Fed tries to be neutral around elections. The Fed when I say neutral, I don't mean partisan. I mean the Fed can take strong actions to affect the markets, and to affect the economy, which can also affect the markets. And so the Fed, one theory over many years has been that the Fed will back off a few months before there's an election, either congressional or presidential election, and kind of be a bit neutral. You can see whether this happens in the next few months. They're not making big changes in interest rates or any other policies. There's another theory that actually, and I guess I should say there's some confirmation of the countervailing theory, which is there is a small bias that the Fed has toward supporting Republican administrations. So they'll provide more stimulus in a little bit before an election in a way that they wouldn't for a Democratic administration. I'm not arguing that's definitive, but there's some strong evidence that that researchers have uncovered to this effect. So you never know, but it's, so pre-election tax, then there's the more general question, I was saying, of what can an administration do? Well, they can badger the Fed to help them, but they can also do the pre-election tax cuts, fiscal stimulus, and pork. Well, what's the actual evidence for the administration and Congress? Well, it turns out that pre-election tax cuts are very popular. And they do happen with some regularity, and not just in the United States, but it's actually all over the world. That's a common tool, and seen to be helpful. But fiscal stimulus and pork, it turns out that the evidence, even though we think there's likely to be a lot of fiscal stimulus, a lot of deficit spending kind of thing, and a lot of pork barrel, bridges to nowhere and so forth, turns out there's really not a lot in the couple of years before an election. Much less than you might think there is, and statistically not significant. Okay, so there's some questions about this stuff. Oh, but still, we have to come back to this question about about performance. Here we got another way of looking at this at this stuff about the first versus the second half of the presidential term, and you see the stock market. The blue line is the change from October 1 of the second year of the term through December 31st of the election year. That's the returns on the S&P 500. And what you see is they're pretty good, compared with the pink, which is the change from January 1st of the inaugural year to September 30th of the second year. So it's 2-year chunks. The first 2 years, the market underperforms. Again, you can see this very clearly. And the second 2 years, it really outperforms. So if you're an investor, clearly what you want to do most of the time is don't invest in the first 2 years of a presidential cycle and pile in to the market in the second 2 years. But but that's the end of the slides. But let me now come to the conclusion here, because there's a really good study that's been done that asks, we know this happens. This is the causation versus correlation. Yes, the markets perform well during the second half of the presidential administration, but when you do the serious study and you do all the probit analyses and all the fancy econometric techniques that you can do, they can't find a reason for it. In other words, presidents and Congress don't really do that much, and whatever it is they do isn't causing the markets to perform. Somehow, the markets are doing this, but they can't find a reason why. And so they're calling this the presidential election cycle puzzle, because there's no good, at least research explanation, which I find intriguing, because I don't know that, certainly the answer isn't there, because what you'd want to do is find the actual reason why the markets have this sort of weird performance in the second 2 years and over the first 2 years. You want to find why before you say, well, the president isn't doing it or the Congress isn't doing it. So, there's clearly some room for argument and disagreement. But I find it really intriguing, because the studies that I'm talking about are quite good and very, very persuasive, that we haven't found the explanation yet. And if that's the case, what they're really arguing is that the phenomenon exists, but all of the actions that you might think that presidential aides or congressional aides or Congress are taking aren't doing anything. They may think that they're doing something, but what it really says is that the economy and the markets are much less manipulable by presidents in their role, or Congress in their role as politicos. We may be trying to save the economy by stimulus spending, but remember, the stimulus spending wasn't in the third year. The stimulus spending was in the first year of the presidential cycle this time around, right? It was a huge $700 billion stimulus package. That was early. Right? It wasn't and you can go back in history and look at that, and that's what you kind of find out. There isn't this sort of lockstep, we got to get elected, let's spend a lot of money, or let's do a lot of pork. They don't find that. But the market is still doing this. So what the conclusion I would lead you to is that presidents and parties and challengers and congressmen, they're all much more the pawns of economic and market behavior than they are the causers of it. That's what this research tends to show, that think about what's going on now. The markets have been doing pretty well, the economy not so much. But can Obama really change things that much? And the conclusion, I think, that comes out of this is that the markets and the economy influence elections, but the folks going through the elections have a much harder time of influencing the economy and the markets than we think they do. It would be, we kind of want them to be able to do it, because then when times are bad, we can bash them, right? It's all Obama's fault, or it's all Bush's fault, or, Clinton, or Reagan, whatever you want to call it. It's all their fault. Or when times are good, yeah, he's my hero. Gets reelected. And I would leave you with that they're much less powerful than we think they are, or we would like them to be. Because the evidence is clear that it's not clear. There isn't any definitive evidence that says that these folks really can succeed in manipulating the markets and the economy in a huge way for the election cycle, right? Certainly the government can help with the macroeconomy by having deficit spending and so forth, but as far as the election cycle is concerned, they're not necessarily succeeding in re-electing themselves that way. They're much more the pawns of, are things good or bad, and then we'll give them a report card on something they don't necessarily control. Okay, so what's an investor to do in all of this, right? Well, one is, you don't have to care what the reason is that the markets tend to do well in the second 2 years of the presidential cycle. You might just say, I want to invest in stocks during that period, no matter what. Now, it doesn't work all the time, but it works most of the time. Another thing that you might want to care about, say is, I don't think I want to worry too much about whether there's a Democrat in office. Well, you could say I want to worry whether there's a Democrat or Republican, because markets do much better under Democrats. You could say that. But I would suggest that you don't want to worry too much about whether markets are invest during Democratic periods and don't during Republican periods. My suggestion is to think long term, and the reason is that everybody has been trying to find short-term factors to play the market. We've been seeing a lot of volatility in the market, including volatility that we think is associated with politics. Sometimes it is, sometimes it isn't. But investors are just dying to find that short-term gain, and even down to electronic trading that goes on in nanoseconds. And if that's the case, you always get think long-term, you can smooth out the bumps. I'm actually saying something different. If everyone is trying to focus on, the influence of the election cycle on the markets today and this month and that month, or what's going on in Europe and how it's going to affect, if they're all focused on the short term, and do I get in the market or out of the market today, by being longer term focused, you can actually do better and beat the folks. Maybe has a better chance of beating the folks who are thinking so short term, because if nobody's focused on the long term, that's where the money can be made, because the investors are looking somewhere else. And that, I think, is something that comes out of this too. That if you say, if I can hold on and not try to move my money around too much, I'll actually do better than the person who's trying to time the markets. And I'll get a better return, not just a smooth return, but a better return. And the example is, individual investors have shunned stocks for the last number of years. Stocks haven't done very well, even though they've gone up a lot the last two and a half years. They haven't generally done very well since the end of the last century. Well, that might are, and they're actually pretty good price now. And so if other people are shunning them, and you can say, I want to invest for a long period of time, maybe you'll do better. On the flip side, people have been piling into treasuries, and they bid up the price of treasuries, and the yields are very low. And people have been saying, oh yeah, got to have treasuries, and we'll just do this little on-off risk thing. If you can say, wait a minute, I may want to use treasuries for diversification, but I'm not going to really pile into them and play that market as much as I have. Well, maybe you're being a contrarian, and you'll do better. So diversify, but have a strategy that's long-term, and you may have better returns. So I hope what I've done here is giving you some thoughts, because I haven't really, you're kind of disappointed because I haven't suggested that we know exactly why markets perform the way they do during certain times, during certain parts of a political regime. We haven't shown, we definitely haven't shown, we've shown that there is really no connection that anybody can find at this point between the actions that politicians take and the results in the market, which in turn goes back onto the election cycle. And yet there are some differences in the way markets perform depending on the political time and the political regime. And then we've also said, how can you invest in light of that? So I'm sorry I haven't given you the definitive answer and said, yes, the Republicans are all bad and the Democrats are all bad, and it's not true. We have some really interesting puzzles and really tantalizing facts, stylized facts, but a lot left to learn and a lot of caution you should be exercising when you think about politics, elections, and the economy and the markets. Anyway, I'll pause there, say thank you very much, and I'd be happy to turn it back over to our wonderful moderator.
Okay, if you could pass your questions to the aisle, please. We'll have the students pick them up. And while we're waiting for that, Brett, maybe I'll fire a question or two at you. Taking a look at the election from a little different approach, one of the criticisms of the corporate community now has been that they've stockpiled cash on the balance sheet. There's $1 trillion or $2 trillion, depending upon who you listen to. And if the corporations would just reinvest that through capital deployment, the economy could grow a little faster. Does the corporate community care which party is in power?
Good question. Well, the question has two parts, of course. One is, what should or could the attitude and actions of corporations be about reinvesting this huge pile of cash they're sitting on? That goes without saying. There is a huge pile of cash. S&P 500 companies are setting records with the amount of money they're saving and not spending. Okay. The second part is, could they or should they invest that money, and what would it do? And the third part is, do they care which party's in power, and would that help loosen the purse strings a little bit? Is that what you're getting at?
That's very accurate, yes.
All right, so we got the first part. They have a lot of cash. The second is, might be, why aren't they spending money? Well, one of the reasons is that they've been making a lot of money without spending a lot of money, or at least the big corporations have. And the reason that that's true is that during the Great Recession, everybody cut back. Consumers cut back. Consumers still not spending a lot. And businesses cut back. Businesses cut back on people, hence the high unemployment rates. They cut back on R&D spending. They cut back on capital expenditures. In other words, what they did is they got their cost base way down, right away, very fast, set records in doing so, how quickly they cut back. And they did it, they sort of understood that in a recession, they can just cut really fast. Then what happens is you can see this in the manufacturing numbers. The manufacturing actually starts recovering in the United States a bit right around the time the stock market takes off, which is the worst part of the worst month of the worst recession since the Great Depression, March of 2009. Why would manufacturing start going up? Well, what happens is there starts to be a little bit of demand from overseas because many countries actually stimulated their economies more than the U.S. did, especially in Asia. So we start to sell stuff overseas, and we start to sell a little bit to IT, computer stuff within the United States. And so some manufacturers start to do better. And what that means, though, is they're selling more, but their cost base is so low that they're making money hand over fist. Because they didn't hire more people, and they didn't spend anything on capital or plant equipment or R&D. And so their margins are really high, and that just continues. They keep not hiring people, and yet they're selling more. And so corporate earnings just go through the roof. Depending on how you measure it, 35% a year in 2009 and 2010, the growth rates. In 2011, that kind of cuts back to about 10% growth in corporate earnings. It's still pretty good. So corporations basically have been making money without having to spend money. Now that may not last, but it's certainly been the case. Now, the question is, which party? Well, of course, corporate America tends to say, when you do polls, that they like Republicans better than Democrats. But it's also not clear because corporate earnings, the same sort of pattern persists in corporate earnings, profits, let's say, as in stock returns. They tend to be higher in Democrat administrations than Republican. And I'm not arguing that means they like the Democrats better. Of course not. But what it means is that a lot of corporations hedge their bets. And what they're looking for is somebody who's going to be relatively corporate friendly, as opposed to, only Republicans and only Democrats. For example, a lot of corporate types loved Bill Clinton because of some policies. And they love George Bush too. So and so forth. So I don't think it's real clear. Maybe you have to review. What else have we got?
I think when you put the slide up about the stock market's performance based on who's in office, and when the Democrats are in office, the stock market in general goes higher. Yeah. Does the same thing play out with sectors, or when we're looking at this from the point of view of an individual investor, do we still hold to those rule of thumbs, Brett, that when the Republicans are in office, in power, then we should be investing in the defense industry, in the energy industry? When the Democrats are in office, should we be investing in health care, consumer staples?
This is great. That's actually a question that's been asked and I think answered in the research literature. I didn't do it, but I was just reading an article the other day on this, and it was convincing to me. The effect that we're talking about here is at the most macro level. It's the stock market overall. The S&P 500, the Dow, the Russell 3000. It doesn't have an effect at the industrial sector level. It does, and it's just what you think doesn't occur. It isn't that defense does better under Republicans and health. There's no effect at all.
Interesting.
Among sectors, you think there'd be a difference in the way certain sectors would perform in different administrations, and they can't find any statistically significant distinctions. Only at the macro level, not at individual sectors.
Here's a good pocketbook question for all of us. Do you think gas prices will have an effect on the election? And what if they suddenly would drop just before Election Day?
Yeah, I should have said something about gas prices, because that's what everybody's been thinking about and feeling the effect of. I'm sorry I forgot, because that has been something that I think Ray Fair, when his model, he runs it again, will find that that's helping to even further narrow the advantage that Obama's got at the moment. And the polls seem to be suggesting that. And it's because people are feeling the effect of gas. When gas gets $4 or more, it really pinches more and more Americans. And that's part of the feeling about, is the economy doing well? If it's not, I hate the incumbent. If it is doing well, maybe I like it. I mean, now, can Obama affect that? This is what we've actually been seeing. Here's an example of what we were talking about. If Obama could affect it, he'd be trying right now to do it. And then, of course, the Republicans are bashing him for not affecting it. Say, oh yeah, you could affect it. You can build pipelines, you can drill. And none of that stuff is going to have much of an effect on oil prices. Because I think it's accurate to say that the oil prices are being determined by worries about the Middle East and global demand picking up in developing countries. We can't affect that. So this is a perfect example of that. We think there's some control, but there really isn't. And of course, the Republicans are bashing whether they think that there's control or not. They're just blaming him. But at any rate, people are feeling not good, and that's, I think, helping to diminish Obama's. So if it keeps going up, I think Obama has some real trouble. I don't think it will, but I think it could. If gas prices drop, let's say, in a couple months before the elections, that'll help Obama. It's very clear that that's, but he doesn't have any control over it. Right. He'll get blamed or get brickbats or bouquets, but not anything he can control.
Do you think the recent upswing in the stock market, is a real true portrayal of the economy?
God, our market's efficient, and I think there's an argument to be made that it is a true portrayal, in the sense that we have a market that's about 13,000. Okay, so is that good or bad? Well, it's really good compared to 6,500 on March 9th, 2009. So we're 100% up. But it's still not up to 14,000 where it was in 2007. began in 2007. So, the glass is half full, the glass is half empty. I think it's a true portrayal in the sense that there's optimism about economic growth. The risk to economic growth is, of course, European meltdown. If Spain or Italy goes down, Greece has already gone down. They're just pretending that it hasn't. If Spain or Italy goes down, I think we're in deep trouble. If Iran succeeds in cutting off the Straits of Hormuz, gets mad, does that, we're in deep trouble. But if those things don't happen, I think we're on this kind of slow upward trajectory, and the market has kind of reflected that. Do I think the market is going to go up another 10% before the end of the year? No, but because that's pretty good numbers already this year. But I think that there is a kind of accurate portrayal of a modest increase. But you have to see it in the context of we're still not back to where we were. So we have a long ways to go.
Okay, part two of the same question. Would you say Obama's stimulus package was used by him to try to juice up the economy to get reelected?
I want to be careful. I'm not trying to be partisan. My sense is that it was not done to get reelected. Although there's always considerations like that. But the problem was the economy was in free fall. It did go down, at an annualized rate of about 8% in March of 2009. Remember, they passed the stimulus package in February of 2009, and it was going down, 6, 7, 8% even at that point, right? So the economy is going down. What had happened in the fall of 2008? Lehman Brothers went under, preceded by Bear Stearns. AIG almost went under. The entire financial system almost went under. And if we hadn't done, I'm not saying we did it right. I'm not saying that by only focusing on the banks, we should have focused on homeowners as well. I'm not saying that was all done right, but if we hadn't done what we did, there was a very serious danger that we were in the Great Depression #2, not just the Great Recession #2. And we would still be, we have 25% unemployment instead of 10% unemployment. There's really a danger of that. And I think that was, and you can see it because the Bush administration was saying the same thing. They were bailing out the banks. They were trying to propose stimulus packages. They were beating up, they were saying, let's work together with the Fed to take a lot of measures. I think this was the spirit of the moment. And whether the stimulus, whether the left-leaners are saying that the stimulus package, Paul Krugman would say the stimulus package wasn't big enough at $700-something billion. The right-wingers would say it's too much. But it was the spirit of the moment, and there was a tremendous fear that we were going to be in much, much worse shape if we didn't do it. Now, could it help down the road if the economy's in good shape? Absolutely. But I don't think that was the primary motive at the time.
Okay. This is an interesting question. How does Ray Farrer's presidential vote model work in instances where there's no incumbent that's running for re-election?
I think what he's done, it's a very good point. What he's done is he's assumed that the party that was just in the White House is considered to be the incumbent. So Al Gore's the incumbent. I think that's what he does. And does it always work? Well, actually, it didn't work very well in 2000. Al Gore election, but nothing worked well in 2000, and it has worked in other cases where there's the president isn't running, but somebody from his party is running. It has worked in those cases. 2000, I think, was one time when Ray Farrer's model didn't work very well, but then nothing else did either. The Electoral College didn't work very well. The vote was so close everywhere.
Okay, last one. Do you think the decision of the Fed on whether or not to perform a QE3 will have a significant impact on this November's election?
I don't think so. I think the Fed is about played out when it comes to QEs. This is quantitative easing, where the Fed has gone through a couple rounds where they've gone in and bought up huge amounts of securities. The Fed can own securities, and often what it will do is buy treasuries or, in instruments from Fannie Mae or Freddie Mac or other kinds of fixed income instruments. And they, before the Great Recession, they owned about, $500 billion worth of securities. Right now, they own about $2.5–3 trillion worth of securities. They went and bought. And what that does is pump money into the economy and also raise the price of these securities to try and keep them from melting down, mortgage-backed securities and so forth. So the question is, would another round of this have much of an effect? Well, the problem is it already owns $2.5–3 trillion worth of this stuff. So if it were to try and have a big effect, it would have to be a huge buying program. Another $1 trillion. $500 billion sounds huge, but it isn't. It wouldn't have much of an effect, or at least that's the view, and I share that view. So there's been a lot of reluctance on the part of the Fed to even go forward with it. The last thing that they did was something where they didn't increase the amount of stuff they had in their balance sheet. They changed it. It was called Operation Twist, and they sold short-term securities like 90-day, 30-day T-bills, and bought long-term treasuries, which had because the short-term stuff already had low interest rates, and the long-term stuff helped raise the price of long-term bonds. So it was an attempt to stimulate and put more money in different parts of the yield curve to help the economy. So they were saying, we don't think just putting more money in will help. We think changing the way that we're investing might help, and I think that's where they are at the moment. I don't think they're going to do it.
Great. Thanks again, Brett. Thanks very much.